A few months ago, I have made a short video on how to draw trend lines, and it got a lot of views, and too many questions from my viewers. Nevertheless, I have noticed that so many traders have been misled on how to trade on trend lines. And I don't blame them, since the misinformation on online trading, and especially on the trendline subject, are spread all over the internet, which makes it very difficult for most inexperienced traders to distinguish between what is false and what is correct. In this video, I have decided to go into details on how to draw trend lines and will provide live charts examples so you can use as a reference to help you understand. Before we begin, please keep in mind that the following points will either decrease or increase the probability of success of the trend line, or it might invalidate the trend line altogether and make it untradeable. So, make sure that you memorize these points, because without them, you will never be able to trade on trend lines successfully. First, the trendline angle must be between 30 to 45 degrees. And this is an important rule to follow to help prevent you from drawing trend lines during a sharply rising or a sharply falling market, or a sideways market. So, you may ask yourself, how to determine the degree of the market trend, since that seems to rely on how much zoomed in or out of the chart you currently are. For example, you could see the market falling sharply, and once you zoom in, the market won't look so sharp anymore. And to solve this simple problem, all you have to do is zoom out of the chart until you can barely see the body of the Japanese candles, then look at how the market is moving. You don't need to be a genius to understand that this, for example, is a sharp down move, while this one here looks more like a 40-degree angle. And this move right here is a sideways market. If you are a beginner, please note that it's very important that you become able to distinguish between a sharp sideways or a trending market. The second point for you to remember is that if you draw your trend lines strictly from the tip of the candle's wicks, then your trend line drawing technique will work across all trading instruments, because it is a universal technique and does not need to be back-tested. However, the downside for drawing trend lines strictly from the wick is that the trade opportunities which you will get won't be frequent, and sometimes very rare, depending on the instrument. Alternatively though, if you draw your trend lines from the body of the candles, or a mix between the bodies and wicks, then you will get a lot more trade opportunities, but this technique, however, will not work on all the trading instruments. So, while it might work on the Bitcoin, for example, it will not work on the Ethereum chart. Which means, you must backtest this alternative trendline drawing technique on the instrument which you want to trade to determine if it will work or not. The third point is that the price must get 3 strong rejections every time it touches the trend line in order to count as a trend line. And you trade based on the trend line from the 4th touch. Basically, there is no way to determine how strong a trend line really is if you do not see the price getting strong rejections from it every time it touches it. So, let's imagine a trend line where the price has faced strong rejections from in the first 2 touches. And after that, once it came back to touch the trend line for the 3rd time, that 3rd touch did not face a strong rejection, and the price has actually slowed down and traded next to the trend line for a while. And then, it finally gets rejected. In that case, if the market comes back for the 4th time to touch the trend line, it won't be tradable, and I would stay out of the market. Unless the price moves up after the slowdown and breaks the previous high. In that case, the trend line will become tradable from the 4th touch, and we never mind the slowdown. Let's move on to the 4th point. You need to look for a price slowdown after every strong rejection off the trend line. Which means, the price must keep a space between each touch where the price action actually slows down. So, if the market becomes very choppy and volatile after the second touch, for example, then the trendline becomes very risky to trade. Also, the fourth touch must happen slowly. So if the price moves sharply during the fourth touch, then the trendline becomes more risky to trade. Keep in mind that in case we have an uptrend line, then the area below and above the trend line is a support zone. So, if the market gets closer to the trend line and gets rejected before touching it, then in that scenario, the touch will still count. And if the price slightly breaks the trend line, then bounces back up. In that scenario, that trend line would still be counted as unbroken and solid, as long as it does not break the previous low. And that's because we look at a trend line as a zone rather than a line. And of course, if we have a downtrend line, then the area above and below the trend line is a resistance zone, and the same rules apply. Following up on the fourth point, there must be a space between every touch. So, here is another scenario. If the market touches the trend line for a second time, and after that, it bounces back up sharply, then it immediately tests the trend line again, shortly after, for the third time. And again, the price bounces back up sharply. In that case, this third touch would not be counted, because it would not qualify as a third touch, since the time space between the second and the third touch is way too short. So, in this case, we count both the second and the third as a one single touch, and we would be left with two touches in total. Let's move on to the sixth and final point, which is that the time space between every touch must be relatively similar. Allow me to further explain. If you were watching a trend line that has been touched 3 times, while the space between the first, the second, and the third touch is around a day or 2, then the fourth touch must take place within the next few days in order to become a tradable trend line. Which means, if the fourth touch happens after a couple of weeks, in this case for example, then the trend line becomes untradeable. And this is actually a very common mistake among beginners. You need to understand that the market must activate a pattern so that it becomes tradable. For example, a double bottom pattern can only be tradable once the neckline is broken. As I have explained in the detailed chart patterns video, which I have added in the description down below. And here too, as I have made it clear already, that the trend line is a pattern and can only be traded once activated. And it gets activated once the price reaches the fourth touch. With that being said, the market tends to change every now and then, so whatever is the fundamental or the technical reason which is causing the trend line to form, that reason is always at risk of fading away through time. So, in short, the longer time it takes for the market to activate a certain trading pattern, the more risky this pattern will become. Let's go to the charts, where I have collected as many examples as I possibly can, to help you understand how to correctly trade on trend lines, and avoid the common mistakes which many traders could spend many years repeating them over and over again. Trend lines can either be traded in the direction of the trend, from the fourth, or it can be traded at the breakout from the fourth, the fifth, or the sixth touch, depending on the market situation. I personally set the 1 hour time frame as the minimum that I could work on. And I highly recommend that you avoid trading on any trend line that has been spotted on the 5 minutes time frame and below. Generally speaking, technical analysis do not work on the low time frames, based on my 20 years of experience. If you like the content of this video, please support the channel by hitting the like, share, and subscribe buttons. We are on the euro against the US dollar daily chart, and I will begin with this incorrect example of a trend line. As you can see, the price did not make any significant bounces after touching the trend line 3 times. While at the third touch, it has remained trading close to the trend line for a few days before bouncing up again, which makes this trend line very risky to trade. By the way, as I have mentioned previously, if the price does not leave a time space between each touch, then we would count all the touches as a one single touch. And here is a perfect example of this. The price has got rejected 3 times off the trend line. However, every time it got rejected, it does not make a new higher high, and comes back to test the trendline zone almost immediately. So we count all the 3 touches as a one touch. This trendline is untradeable. The next chart here might be an easier incorrect scenario which you can identify. The price got 2 strong rejections in the past, but when it came back on the third touch, it did not get rejected, which makes this trendline untradeable. By the way, a lot of people think that you can trade on a trendline from the third touch, which is one of the biggest misinformation that has been spread on the internet on technical analysis. I get contacted by so many students telling me that they have been trading the trendline from the third touch and never been consistently successful. Anyways, let's move on to the next chart example. This time, the price made a decent bounce from the first touch, then another decent bounce from the second and third touch, making higher highs every time it bounces, which makes this a solid trend line. However, on the fourth touch, the price did not face a strong rejection and remained trading next to the trend line for a few days, which is a sign of weakness. So in this case, I would buy right after the dodgy candlestick, and I would place the stop loss below the previous low, while the target is at the previous high. Moreover, once I see the price slowly moving next to the trend line, instead of facing a strong rejection, I would close at least 75% off my trading position on profit, and leave 25% running. And once I see the price breaking the uptrend line and closing below it, I would close my remaining 25. And I would reverse with a sell position. Remember, solid trend lines can also be traded once broken, and the stop loss in this case is above the previous high. Keep in mind, in this situation, since the overall market trend is down, thus, if you sell after the breakout of the solid trend line, your success probability will be very high. Let's switch to the Bitcoin. We have a trend line which has formed on the 1-hour chart. The first touch constitutes of multiple candles, facing strong rejections, and ending up with long wicks, which is a good starting sign, because strong rejections will add to the strength of the trend line. And here it went for the second touch, and got a clear rejection. Then the price went back to touch the trend line again, for the third time. However, this time the price remained trading next to the trend line for a while, before getting rejected for the third time, which is a sign of weakness for the trend line, because we should always prefer to see a clear rejection as soon as the price touches the trend line, rather than slowing down next to it. Nevertheless, the price went down after the third touch, and has hit a new low, which means we can disregard the slowdown over here, which makes this trend line a solid trend line. Hypothetically speaking, if the price has not hit a new low after the third touch, this will make it a weak trend line, and I would have had preferred to ignore it. And sure enough, after the price went back to touch the trend line for the fourth time, presenting a sell opportunity, it got a decent rejection, and if I would sell from here, I would place my stop loss above the previous high, while the target would be 2 times the value of the stop loss, which is around here. Notice how the price has significantly slowed down over here, with the candles getting a lot smaller the closer they get to the trend line. Moreover, remember when I have repeatedly mentioned in this video that if the price slows down next to the trend line, that slowdown could indicate that the trend line is getting weaker. In this scenario, however, the price kept getting slower and slower the closer it got to the trend line, which indicates, with a 100% certainty, that the trend line is getting much weaker while the market is most likely preparing for a breakout and presenting a buy opportunity from here as soon as we got a candle close above the trend line to confirm the breakout. This is a perfect example of how to trade a breakout of a solid trend line. And here is another example on the Bitcoin of a very common mistake which most beginners do when they draw trend lines. Can you tell why it's incorrect? Go ahead and pause this video and give it a deeper thought. The answer is, it's because the angle of the trend line is too sharp. Remember when I have mentioned earlier in this video that the best trend line angles should be between 30 to 45 degrees. While the best way to spot the angle is when you zoom out of the chart until you barely see the candle bodies. Even though this trend line's angle may look like a 40-degree angle. However, check out what happens now once I zoom out of the chart. Now the angle looks obviously too sharp, and I think you got an idea on how important it is to zoom out of the chart before drawing the trend line. Thus, you will be able to avoid this most common beginner's mistake, and your trading will greatly improve. And here is another example on the Bitcoin. The trend line has been drawn from both the candle wicks and bodies. And if you have been paying attention to this video, you should find it easier to deal with this situation. The first touch is where the market has faced strong rejections. The second touch is where the market broke out above the line, but did not break the previous high, and reversed back down sharply. And, as I have mentioned earlier in this video, a trend line is not necessarily a line, and rather should be treated as a zone. So, if the price had broken above the first high, then we would have had assumed that the trend zone is weak, and we won't bet on the trend line. Same goes for the third touch, as the price has approached the trendline zone and slowed down before getting rejected. However, since it actually slowed down here and failed to make a lower low, then climbed back up again to touch the trendline for the fourth time, where it has slowed down significantly. So, what does a significant slowdown signal in this case? It signals that the trendline is too weak, and the price can break it at any moment. And the correct trade would be right here, at the fifth touch, as soon as the candle closes above the trend line. We buy here, with a stop loss below the low. So the risk-to-reward ratio is 1-to-1. We can't have a better reward on this one, for a good reason, which is that the market has slowed down multiple times in the past, and slowdowns create confusion and uncertainty in the market. Allow me to clarify. Hypothetically speaking, if the market had reversed sharply every time it has touched a support level, instead of slowing down, that would have had added a lot of strength to the breakout, whereas I would have had increased the value of my profit target. So, again, since the market has actually slowed down a few times and created an uncertainty as a result, it would be wise to secure smaller profit targets. I will try to go over as many trendline scenarios as I possibly can, as I think it's very important that you understand how to draw the trend lines and how to trade them. If you like the content of this video and you want to see more content in the future, please help my channel by hitting the share, like, and subscribe buttons. Let's move on with more chart examples. This time I have picked the Nasdaq 100 on the 1-hour time frame. We had the first touch, which is also a retest of the support level, which the price has broken recently, and has now turned into a strong resistance level. And as you can see, the price fell down sharply after the first touch. The second touch is where the price has failed to come near the trendline zone, and it has slowed down. Afterwards, the price fell down sharply, and printed a new low. Which means, even though the second touch did not actually come anywhere near the trendline zone, we can still count it as a second touch. And here is the third touch. Notice that the price did not break the previous high, which is very important. Because, if it did break the previous high, then we won't have a trendline to watch and trade on. In other words, a downtrend line must constitute of lower highs. The price has fell down sharply after the third touch, and even though it did not make a new low, we can still count it as a third touch. Simply because it fell down sharply, which signals the powerful strength of the trend line. And here is the fourth touch, which happened the next day, where the price could not touch the trend line and fell down sharply. So the question is, how can you trade in this situation? Because if your plan was to sell from the trend line, then you must have missed the trading opportunity. Before you answer the question, and if you have not watched my video on the Japanese candlestick patterns, please do it now, as it will go hand in hand with trading on trend lines. For your information, I have made what I believe is the best video on the Japanese candlesticks, which will actually help you make money. Nevertheless, I have left a link for the Japanese candlesticks video down in the description below. Now back to the trendline chart. And the answer is: we sell at the close of the bearish engulfing candlestick. And the combination between the downtrend line and the bearish engulfing has given us a very strong sell signal. The following example is a trend line on the crude oil chart. And so far, it is the most perfect example in this video. Because the price has reversed sharply after every touch, and slowed down and traded sideways between every touch. While the time space between every touch is very similar. And as always, the trade opportunity is from the fourth touch. We buy from here, with a target at the previous high. While the fifth touch is where the price has significantly slowed down, right at the trend line, signaling that the trend line is getting weaker with a 100% certainty. And we sell from here once we see the slowdown. There is no similar educational video out there that explains the correct application of trend lines and how to trade based on them. And keep in mind that all what has been mentioned in this video is based on my 20 years of trading experience. Nevertheless, I have shared with you these valuable information for free, which will save you many years off your trading journey, trying to weed out the misinformation. As the internet is full of misinformation. And all I am asking in return is that you hit the like, share and subscribe buttons to support my channel. If you have any question, please post it in the comment section, and I will most certainly respond to it. The next example is on the Ethereum chart. I want to include this incorrect example, because I have seen a countless number of newbies drawing a trend line similar to this one, and whenever they lose their money, they would attribute their loss to their bad luck. And never think for a minute that their loss came as a direct result of their incorrect application of a trend line. Can you tell why this trend line is incorrect? Please pause this video to give it a deeper thought. The answer is: it's because the market has slowed down significantly after bouncing off the low. This slowdown could either result in having the price retracing back up, or it could result in having the price dropping down. But in order for the trend line to become tradable, you need to see the price dropping down sharply after every touch of the trend line. And if it slows down next to the trend line, then it must drop down and print a new lower low. And here is a similar incorrect example on the British pound against the US dollar. Notice how the market has slowed down as it approached the trend line. with no significant sharp rejections every time it has touched the trend line. While after the third touch, it slowed down significantly and could not break the previous low, which makes this trend line untradeable. Now that you got an idea on how to deal with the different market situations. Therefore, once you begin to practice this trendline strategy, you will know what to look for. And as a result, you will find that all of these market situations are very repetitive and very predictable. Before I finish this video, let's go back to the time frame subject. I just want to add that you should not mix the time frames together. Which means, if you spot a trend line on the daily chart, you can't mix it with other patterns which you might spot on the lower time frames. And this is actually one of the misinformation that has been spread all over the internet, which tells you that, if you spot a pattern on a certain time frame, you should run another chart with a lower time frame to see if you can spot another pattern inside the first pattern, which could help support your trading decision. People who talk about such a trading technique do not actually practice trading in the real world. Allow me to explain why. Here is a daily chart example on the Nasdaq, with the market giving us a strong buy signal from the fourth touch of the trend line. The stop loss should be placed below the previous low, which is around 600 points. Now, let's check the lower chart time frame to find a better trade entry, which is the way how it should work, according to the delusional people who embrace mixing the high and low time frames together. Here is the 1 hour chart, and this area here represents this area here on the daily chart. And according to the daily chart, we should buy from the touch of the trend line, which translates into buying from here on the 1 hour chart and placing a 600 point stop loss. However, according to the time frame mixing strategy, you should exit your buy position at a loss because the market has just broken the previous low on the 1 hour chart. And again over here, according to the double bottom pattern on the 1 hour chart. You should buy again once the price breaks the neckline. So you will end up with a buy trade that has a 1,400 point stop loss, instead of only 600 point stop loss if you have had taken the trade from the lows, according to the daily chart. I can show you hundreds of examples for how a perfect trade opportunity setup on the higher time frame could get completely screwed up if you decide to base your trade entry or stop loss on the lower time frame. So, I strongly recommend that you ignore the misinformation and stick with the time frame that has given you the original trade opportunity and base your decision on where to enter and exit the market based on that original time frame. Thank you for watching, and remember to always keep it simple when you trade. If the trading strategy does show consistently profitable results on the backtest, then you should stick to it on the best performing time frame. And I will see you in the next video.